The contemporary geopolitical and economic landscape, the intersection of foreign policy and domestic financial stability has become increasingly prominent. The exchange between Senator Whitehouse and Mr. Bessent, which took place in the context of a confirmation hearing for a high-level Treasury position, exemplifies how thoughtful oversight and proactive engagement are crucial for understanding the interconnected risks that modern economies face. The conversation began with a clear acknowledgement of the immediate geopolitical and trade concerns that are shaping the United States' strategic posture. Senator Whitehouse welcomed Mr. Bessent and expressed appreciation for the preliminary discussions they had in a prior meeting. He underscored the urgency of applying additional sanctions on Russia's shadow fleet, which has been implicated in the sabotage of critical infrastructure in the Baltic region. The senator's concern reflected a broader recognition that covert maritime operations can directly undermine both national and allied economic security. The shadow fleet, operating under opaque ownership structures, is capable of evading standard regulatory and enforcement mechanisms, thereby creating an environment of uncertainty for both military and commercial shipping. Senator Whitehouse highlighted that these activities are not merely symbolic or tactical in nature, but have cascading implications for global trade networks, energy supply chains, and regional stability. By emphasizing this, he established the gravity of immediate policy responses, framing the sanctions discussion not merely as a diplomatic maneuver, but as a necessary step in safeguarding long-term economic resilience. In tandem with the geopolitical discussion, the senator drew attention to issues of domestic economic fairness, specifically addressing the competitive disadvantage faced by U.S. manufacturers when compared to foreign producers operating under lower environmental standards. This point underscores a fundamental tension in global trade: how to maintain competitive equity while simultaneously upholding environmental and labor standards. Senator Whitehouse expressed strong support for initiatives that would prevent Chinese manufacturers from leveraging lower environmental compliance costs to undercut American producers. This acknowledgement reflects a broader concern about the alignment of trade policy with national economic and environmental goals. In highlighting these concerns, the senator subtly framed a dual agenda: one that requires vigilance in foreign policy to counter immediate security threats, and one that demands careful calibration of domestic economic policy to ensure a fair and sustainable industrial landscape. Such framing is critical because it signals to nominees and policymakers that oversight extends beyond narrow policy silos. It involves understanding the interdependence of trade, environmental policy, and economic competitiveness. Transitioning from these introductory concerns, Senator Whitehouse moved the discussion toward a more immediate and tangible economic threat: the vulnerability of the insurance industry to climate-driven shocks. He highlighted the increasing frequency and intensity of natural disasters, citing wildfires in California and other climate-related disruptions in Florida as indicative of a broader systemic risk. By framing this threat in terms of its potential to trigger cascading economic failures, the senator provided a clear, data-backed rationale for heightened scrutiny. The logic is straightforward yet profound. Insurance serves as a foundational mechanism for economic stability. Where coverage is unavailable or prohibitively expensive, homeowners and businesses cannot secure mortgages. Without mortgage access, property values stagnate or decline, creating ripple effects that extend into the broader financial system. Senator Whitehouse emphasized that this chain reaction mirrors, in structural terms, the crisis that led to the 2008 financial collapse. The analogy is particularly instructive because it situates the climate insurance nexus within a historical precedent, demonstrating that systemic economic crises often emerge not from a single shock, but from the failure of interconnected financial institutions to absorb escalating risk. To ground his warnings in empirical evidence, the senator referenced specific reports, including a Senate Budget Committee report compiled during his tenure as chair. This report meticulously cataloged insurance non-renewals, premium increases, and outright unavailability across U.S. counties. Senator Whitehouse requested that Mr. Bessent assign a member of his team to review the report and provide a summary. By doing so, he illustrated a crucial principle of oversight: the need for high-level officials to engage directly with data and to ensure that policy decisions are informed by detailed, region-specific evidence. This step is not merely procedural. It underscores a broader philosophy of anticipatory governance, in which policymakers actively assess vulnerabilities and seek to mitigate cascading economic risks before they crystallize into full-blown crises. The senator also referenced an article in The Economist, noting with appreciation that Mr. Bessent had read it in advance. This exchange, while seemingly minor, is symbolically significant. It demonstrates an unusual level of engagement and intellectual preparation on the part of the nominee, signaling respect for the gravity of the issues at hand and a willingness to engage substantively with complex, interdisciplinary challenges. Senator Whitehouse's approach throughout this segment is methodical, balancing urgency with measured communication. He does not resort to theatrical or confrontational tactics. Rather, he systematically connects issues that are often treated in isolation: climate change, insurance markets, mortgage accessibility, housing values, and broader economic stability. By establishing these linkages, he reframes what might otherwise appear as disparate policy concerns into a coherent narrative of systemic risk. The senator explicitly references Ernest Hemingway's observation that bankruptcies happen gradually, then suddenly, drawing a literary analogy that effectively captures the latent, cumulative nature of economic vulnerabilities. This analogy serves as a cognitive anchor for both the nominee and observers, illustrating that the insurance crisis, while unfolding quietly, has the potential to cascade into a nationwide economic disruption if unaddressed. In addition to highlighting systemic vulnerabilities, Senator Whitehouse emphasizes the importance of foresight and preparedness. He notes that it has provided voluminous resources, including high-level peer-reviewed studies, to the nominee and his team. These studies document the economic ramifications of climate-related disruptions, including sector-specific impacts, regional disparities, and the potential for broader financial instability. By referencing these materials, the senator reinforces the principle that oversight is not about reactive measures, but about proactive engagement with credible research and data. The implication is clear. Effective leadership at the Treasury level requires not only understanding current economic conditions, but also anticipating emergent risks that may not yet be reflected in market pricing or conventional economic indicators. This opening segment of the exchange also sets the stage for a discussion about personal credibility and the alignment of policy leadership with ethical and legal standards. While the initial focus is on systemic economic and geopolitical risks, the conversation naturally transitions to the nominee's personal tax practices, particularly regarding the structuring of partnerships and the payment of Medicare taxes. Senator Whitehouse frames his inquiry carefully, acknowledging the complexity of the issue while highlighting its broader significance. The question is not framed as a political attack, but as a matter of legitimacy. A Treasury Secretary who oversees the IRS must maintain public confidence by ensuring that personal tax practices align with statutory requirements and regulatory interpretations. This is a subtle but critical point. The senator is drawing a line between systemic oversight responsibilities and personal conduct, emphasizing that credibility in the former is inseparable from integrity in the latter. Mr. Bessent's response is equally measured. He notes that the matter is under litigation, confirms that all taxes are current, and commits to creating provisions to address the contested amounts if necessary. He also agrees to shutter his firm upon confirmation. This response, while carefully constructed to avoid premature admissions, signals a recognition of the gravity of the concerns raised. The exchange, therefore, serves as a model of effective oversight. It is rigorous, data-informed, and principled, yet conducted with civility and precision. The broader lesson is instructive. It demonstrates how high-stakes hearings can transcend partisan theatrics when participants focus on substantive issues, connect complex systems, and insist on accountability grounded in evidence rather than spectacle. In conclusion, the first segment of this hearing encapsulates a multifaceted approach to oversight that is both proactive and holistic. Senator Whitehouse's line of questioning traverses the geopolitical, trade, environmental, and financial domains, weaving them into a coherent narrative of systemic risk. By doing so, he establishes a framework for understanding how emerging threats, particularly climate-driven disruptions in the insurance sector, can cascade into nationwide economic instability. Simultaneously, he underscores the importance of personal integrity in leadership positions, framing ethical conduct as inseparable from professional competence. The exchange illustrates that true oversight requires not only technical knowledge and analytical skill, but also the capacity to synthesize information across domains and anticipate cascading consequences. For policymakers, economists, and engaged citizens alike, this segment serves as both a cautionary tale and a blueprint. Crises are rarely isolated, and preparedness demands foresight, rigor, and principled engagement. The modern financial system, while resilient in many respects, remains fundamentally dependent on a series of interlinked institutions that serve as both mechanisms of risk management and conduits of economic activity. Among these institutions, insurance companies occupy a particularly critical role. Their ability to assess price and absorb risk underpins the broader stability of property markets, lending institutions, and investment flows. During the Senate confirmation hearing, Senator Whitehouse highlighted this interdependence, drawing attention to a looming crisis within the insurance sector, one driven not by conventional financial mismanagement, but by the accelerating impacts of climate change. This line of questioning underscores a vital truth. Systemic economic risk is no longer confined to banking or monetary policy alone. It increasingly arises from environmental and climate-driven shocks that propagate through traditional financial mechanisms. Insurance companies operate on the principle of risk pooling. By aggregating premiums from many policyholders, insurers can absorb losses from those few instances of catastrophic damage without threatening their solvency. This model depends on predictability. Insurers must be able to assess historical and projected risks with sufficient confidence to price policies effectively. Climate change, however, has introduced a level of volatility that undermines these assumptions. The frequency and intensity of wildfires, hurricanes, floods, and other natural disasters have increased sharply over the past decade, with a pronounced acceleration observed in the past 5 years. Senator Whitehouse cited examples from California and Florida, regions that have experienced both extreme fire seasons and hurricanes that have severely stressed local insurance markets. In California, insurers have responded to escalating wildfire risk by either sharply increasing premiums, non-renewing policies, or exiting the market entirely. Florida, with its hurricane exposure, faces similar patterns, exacerbated by rising sea levels and the intensification of storm surges. The senator's discussion brought these emerging market realities into sharp relief, emphasizing that insurance scarcity is not an isolated administrative concern, but a fundamental threat to economic stability. The implications of these insurance market failures extend well beyond immediate concerns of homeowners and businesses. Mortgage markets, for example, are inextricably linked to insurance availability. Lenders typically require comprehensive insurance coverage as a condition for issuing mortgages. When insurance becomes scarce or prohibitively expensive, access to mortgage credit is restricted, creating a direct bottleneck in the housing market. Properties without mortgages, or with mortgages that carry significantly higher costs due to insurance constraints, face diminished market value. This, in turn, affects not only individual property owners, but also local tax bases, municipal budgets, and broader economic confidence. Senator Whitehouse emphasized this cascading effect, noting that a seemingly localized insurance problem can, if left unchecked, propagate into a nationwide economic disruption reminiscent of the 2008 financial crisis. By connecting insurance market failures to broader financial outcomes, he reframed the technical issue as a matter of national economic security. Central to this argument is the notion of a feedback loop between climate risk, insurance availability, and economic valuation. When insurers withdraw coverage or dramatically increase premiums, homeowners may be forced to either forego insurance or sell properties at reduced prices. Declining property values then erode homeowners' equity and reduce consumer confidence, further constraining spending and investment. Banks and other financial institutions, observing heightened default risk and declining collateral value, tighten lending standards. This contraction of credit availability can amplify economic downturns, creating a self-reinforcing cycle of decline. Senator Whitehouse cited data collected during his tenure on the Senate Budget Committee, highlighting county-by-county patterns of insurance non-renewals, premium spikes, and coverage gaps. This level of granular analysis is particularly important because it allows policymakers to identify hotspots where systemic risk is most acute and where intervention may be most urgently required. Without such detailed data, Interventions risk being either misdirected or insufficiently calibrated to severity of local conditions. Senator Whitehouse also drew attention to the interconnectedness of these risks with broader economic and social policy concerns. Housing market instability does not exist in a vacuum. It affects municipal revenues, social mobility, and intergenerational wealth accumulation. Regions with constrained insurance access may experience population outflows, depressed property values, and strained public services. The senator's discussion highlights a crucial insight. Climate change is not only an environmental or technical challenge, but a fundamentally economic and social issue. Financial policymakers, therefore, must adopt a multidimensional perspective, integrating climate science, actuarial analysis, and socioeconomic forecasting into their decision-making frameworks. Failure to do so risks creating policy silos that leave critical vulnerabilities unaddressed. Moreover, Senator Whitehouse emphasized the importance of leadership engagement in confronting these systemic risks. He noted with approval that Mr. Bessent had read the materials provided, signaling a level of preparedness and intellectual engagement that is unusual in confirmation hearings. This detail, while subtle, is instructive. Effective oversight in policy development require leaders who are not only willing to review evidence, but also able to synthesize complex, cross-domain information and make decisions based on long-term risk assessments rather than short-term political considerations. By acknowledging this engagement, the senator reinforced the expectation that nominees in senior financial positions must be both analytically competent and intellectually proactive. Another critical dimension of the discussion involves the implications for financial market confidence. Investors, bank, and corporate actors closely monitor the stability of insurance markets because disruptions in risk transfer mechanisms can affect asset pricing, credit spreads, and investment decisions. If insurers withdraw from markets en masse or dramatically increase premiums, the ripple effects extend beyond local housing markets to regional banking systems, commercial lending, and even national financial stability. Senator Whitehouse's framing makes it clear that these effects are not theoretical. They are observable trends with real-world consequences. In this sense, the discussion elevates the climate insurance nexus from an isolated sectoral issue to a systemic economic concern, requiring immediate attention from both policymakers and financial institutions. In addition to the market and economic considerations, the segment highlights a critical governance lesson: the importance of interagency coordination and proactive oversight. Addressing systemic vulnerabilities requires the engagement of multiple stakeholders, including the Treasury Department, state insurance regulators, the Federal Reserve, and local government entities. The senator's insistence on detailed county-level data reflects a recognition that granular, localized analysis is necessary to inform broader policy decisions. This approach also embodies a principle of anticipatory governance. By mapping vulnerabilities and simulating potential cascading impacts, policymakers can develop targeted interventions that minimize systemic risk while preserving market functionality. The hearing segment also implicitly raises questions about equity and social justice. Insurance availability is closely tied to property ownership, wealth accumulation, and community stability. When high-risk areas experience insurance scarcity, the consequences disproportionately affect lower-income homeowners who may lack the resources to relocate, retrofit properties, or absorb higher premiums. This dynamic exacerbates existing inequalities and underscores a moral imperative for policymakers to consider distributional effects in risk mitigation strategies. Senator Whitehouse's emphasis on foresight, grounded in evidence and analysis, implicitly recognizes this intersection of economic stability, social equity, and climate resilience. Finally, the segment illustrates a broader lesson about the nature of modern crises. Senator Whitehouse's framing, drawing connections between climate-driven disasters, insurance market failures, mortgage access, property valuation, and systemic economic stability, demonstrates that contemporary crises are rarely confined to a single domain. They are complex, interdependent, and often nonlinear. Effective oversight, therefore, requires an integrative approach, one that transcends traditional policy silos and emphasizes cross-domain analysis, early warning mechanisms, and proactive intervention. By articulating this perspective, the senator not only signals the seriousness of the risks, but also models a framework for how policymakers should approach systemic vulnerabilities in an era defined by climate uncertainty and financial interdependence. The dialogue between Senator Whitehouse and Mr. Bessent, particularly as it moves into systemic financial risks and policy preparedness, offers a rare insight into the intricate responsibilities that accompany senior Treasury leadership. Whereas traditional confirmation hearings often revolve around credentials and general policy positions, this exchange illuminates the necessity for a nominee to comprehend not only the immediate obligations of office, but also the latent vulnerabilities inherent in complex economic systems. The senator's discussion highlights two converging dimensions of leadership responsibility. First, the anticipation and mitigation of systemic risk, particularly that which originates from climate-driven shocks to the insurance sector. And second, the cultivation of personal credibility and alignment with legal and ethical tax standards. These two threads, though distinct in subject matter, are united by a common principle: the maintenance of confidence, both in financial markets and in the public perception of governance, is contingent upon foresight, transparency, and integrity. At the core of this segment is the theme of policy preparedness in the face of emergent risks. Senator Whitehouse emphasizes that the insurance industry, long considered a stable pillar of economic infrastructure, is increasingly vulnerable to climate change. This vulnerability is not hypothetical. It is manifested in observable market behavior, including policy non-renewals, significant premium hikes, and outright withdrawal from high-risk regions. Such behavior is most pronounced in states like California and Florida, where wildfire and hurricane risks have escalated beyond historical averages. However, the senator's analysis extends beyond these geographic examples to underscore the national ramifications. The withdrawal or restriction of insurance coverage in localized areas has the potential to trigger a nationwide ripple effect. Homeowners unable to obtain insurance cannot secure mortgages, leading to reduced property values, diminished local tax revenue, and broader financial instability. Senator Whitehouse's framing demonstrates a sophisticated understanding of economic interconnectivity, where sector-specific failures can escalate into systemic crises. This perspective demands a high level of analytical acuity from any nominee for Treasury leadership. By requesting that Mr. Bessent's team review detailed reports from the Senate Budget Committee, specifically county-by-county data on insurance non-renewals, price increases, and coverage unavailability, the senator illustrates the necessity of data-driven oversight. Such granular data is essential for informed decision-making, allowing policymakers to identify hotspots of vulnerability and prioritize interventions where they are most needed. Moreover, the senator underscores the importance of integrating empirical research into policy discussions, citing peer-reviewed studies and comprehensive analyses on climate-driven economic risk. The act of providing these materials signals an expectation that senior financial officials not only absorb evidence, but also synthesize into actionable policy frameworks. It reflects a broader philosophy of anticipatory governance, wherein crises are addressed proactively, based on the evaluation of credible evidence, rather than reactively, after the damage has already occurred. A significant aspect of this segment lies in its exploration of ethical governance and public credibility. Beyond systemic risk, the senator addresses a sensitive matter regarding Mr. Bessent's personal tax practices, specifically the structuring of partnerships in a manner that has drawn scrutiny from the IRS. While the issue is complex and under litigation, the senator's line of questioning is framed not as a partisan attack, but as a matter of alignment between personal conduct and professional responsibility. The reasoning is clear. A Treasury Secretary who oversees the IRS must exemplify adherence to tax regulations and must maintain the trust of both the public and the institutions they supervise. Even the perception of misalignment between personal tax behavior and regulatory standards can undermine public confidence, potentially weakening enforcement and compliance efforts at a systemic level. By introducing this line of inquiry alongside discussions of macroeconomic risk, Senator Whitehouse emphasizes the inseparability of personal integrity and institutional credibility. Mr. Bessent's response is both measured and instructive. He acknowledges the litigation, confirms that all taxes are up to date, and commits to creating provisions to address any contested amounts if necessary. Furthermore, he agrees to shutter his firm upon confirmation. While these measures do not constitute an admission of wrongdoing, they demonstrate recognition of the seriousness of concerns and a willingness to implement protective guardrails. The interplay between the senator's probing questions and the nominee's thoughtful responses exemplifies effective oversight, wherein accountability is established without resorting to theatrics or confrontation. This model of engagement underscores the principle that governance requires both rigor and respect for due process. The conversation also sheds light on the broader consequences of climate-driven economic disruptions for financial stability. Insurance availability serves as a linchpin connecting climate risk to mortgage markets, housing values, and the overall economy. As premiums rise or coverage is restricted, homeowners may be unable to secure mortgages, forcing property sales at reduced prices. Lower property values erode wealth, constrain consumption, and reduce municipal tax revenue, potentially triggering fiscal stress in local governments. Banks and other financial institutions, facing increased collateral risk, tighten lending standards, further exacerbating contraction of credit. This chain reaction illustrates how climate change functions not merely as an environmental challenge, but as a systemic economic risk multiplier. The senator's articulation of this dynamic emphasizes the importance of Treasury leadership that is both strategically aware and operationally capable, with the foresight to anticipate cascading failures before they crystallize. In addition to systemic risk considerations, the segment emphasizes the importance of data integration and modeling for policy formulation. Senator Whitehouse references county-level insurance reports and peer-reviewed studies, highlighting the necessity of combining localized empirical data with broader economic models. Such integration enables policymakers to simulate potential cascading effects, assess sector-specific vulnerabilities, and design interventions that are both targeted and effective. For instance, state or federal programs could be developed to provide reinsurance in high-risk regions, subsidize premiums for homeowners in vulnerable areas, or incentivize climate-resilient construction practices. By grounding policy discussions in both quantitative data and qualitative analysis, the senator exemplifies an evidence-based approach to governance that prioritizes proactive mitigation over reactive remediation. The segment further underscores the interconnectedness of policy domains, illustrating how climate risk, insurance markets, mortgage availability, and housing values intersect with broader economic and social outcomes. Insurance scarcity affects not only individual homeowners, but also regional economic vitality, municipal fiscal health, and social mobility. Populations in high-risk areas may face displacement or financial hardship, amplifying pre-existing social inequities. By connecting these dots, Senator Whitehouse demonstrates that effective policy cannot be formulated in isolation. It requires a multidimensional perspective that integrates economic, social, and environmental considerations. Another key theme of this segment is the role of anticipatory leadership in fostering market and public confidence. By presenting comprehensive evidence and requesting that the nominees' team review detailed reports, the senator conveys that leadership entails proactive engagement with emerging risks. Mr. Bessent's acknowledgement of the materials and his readiness to engage substantively reflects a level of preparedness and analytical rigor that is rare in confirmation hearings. This dynamic highlights a critical governance lesson. Leaders who understand the interplay between systemic risk, policy tools, and market behavior are better positioned to implement interventions that mitigate cascading crises. The segment also explores the policy tools available to address systemic climate-related financial risks. These tools range from regulatory mechanisms and public-private partnerships to fiscal interventions and market incentives. Regulatory measures can include enhanced disclosure requirements for insurers regarding climate exposure, mandatory stress testing for catastrophic events, and restrictions on withdrawal from high-risk regions without contingency planning. Public-private initiatives might involve federally backed reinsurance programs, risk-sharing mechanisms, or investment in resilient infrastructure. Fiscal strategies can include targeted subsidies for homeowners, incentives for climate-resilient building practices, and adjustments to mortgage insurance programs to account for heightened environmental risk. Each of these approaches requires careful calibration, balancing economic efficiency with social equity and long-term resilience. The discussion also emphasizes historical context and precedent. By referencing the 2008 financial crisis, Senator Whitehouse illustrates how systemic vulnerabilities, if left unaddressed, can escalate into nationwide economic calamities. The comparison is instructive, whereas the 2008 crisis was triggered by mortgage-backed The exchange between Senator Whitehouse and Mr. Bessent offers profound insights into the responsibilities that come with senior Treasury leadership, particularly in an era of increasing climate-driven economic risk. Segment 4 focuses on the critical intersection of financial system resilience, regulatory oversight, and the role of the Treasury in proactively mitigating cascading economic disruptions. In previous segments, the discussion emphasized the cascading risks stemming from insurance market failures, mortgage accessibility, and property value erosion. This segment continues a narrative, examining how proactive Treasury action, ethical governance, and integrated policy frameworks can address systemic vulnerabilities and prevent localized crises from escalating into nationwide economic shocks. At the core of this discussion is the recognition that financial system resilience depends on proactive risk management and anticipatory governance. The insurance sector, as highlighted by Senator Whitehouse, serves as a linchpin connecting climate events to broader economic outcomes. When insurers withdraw coverage in high-risk regions, homeowners face increased difficulty securing mortgages, resulting in property value declines, decreased consumer confidence, and reduced lending activity. This creates a feedback loop that can destabilize local and national economies. Treasury oversight in this context extends beyond traditional fiscal management. It includes assessing systemic vulnerabilities, modeling cascading impacts, and developing policy instruments to preserve stability. The Senator's emphasis on detailed data review, including county-level insurance reports and peer-reviewed studies, underscores the necessity of evidence-based policy development as a cornerstone of modern Treasury leadership. One of the most important aspects of this segment is a discussion of policy instruments available to mitigate climate-driven economic shocks. Senator Whitehouse and the broader committee emphasized that effective Treasury leadership requires a nuanced understanding of regulatory levers, fiscal tools, and public-private partnerships. Regulatory measures can include enhanced reporting requirements for insurers on climate exposure, mandatory stress testing for catastrophic events, and limits on insurer withdrawal from high-risk areas without adequate mitigation plans. Fiscal strategies might involve federally backed reinsurance programs, targeted subsidies for homeowners in vulnerable regions, or incentives for climate-resilient construction. These interventions are not merely theoretical. They require careful calibration to balance market efficiency with social equity and long-term economic stability. By highlighting these tools, the Senator frames the Treasury not only as a manager of fiscal policy, but also as a proactive agent in systemic risk prevention. In parallel with systemic policy measures, ethical governance and credibility remain central to the discussion. The questioning regarding Mr. Bessent's personal tax practices illustrates a fundamental principle. Effective Treasury oversight is inseparable from personal integrity. A Treasury Secretary who exemplifies compliance with tax regulations and ethical conduct reinforces public trust in both fiscal policy and regulatory enforcement. Conversely, perceived misalignment between personal behavior and statutory obligations can undermine confidence, weakening the efficacy of policy interventions and diminishing public adherence to regulations. By connecting ethical governance to systemic financial risk, Senator Whitehouse underscores a holistic understanding of resilience that encompasses both institutional and personal credibility. Segment 4 further explores the interconnectedness of policy domains, emphasizing that climate-driven risks do not exist in isolation. The destabilization of insurance markets affects mortgage access, property values, municipal revenue streams, and social mobility. Homeowners in high-risk areas face not only financial loss, but also potential displacement, contributing to socioeconomic inequities. Municipalities experience reduced tax revenue, straining public services and infrastructure investments. Banks face increased default risk, prompting tighter lending standards and constricted credit flow. These feedback loops demonstrate the multidimensional nature of systemic risk and highlight the imperative for integrated, cross-domain policy solutions. Treasury oversight, therefore, must incorporate environmental risk assessment, economic modeling, and social equity considerations into strategic planning. Case studies of regional impact provide concrete illustrations of these dynamics. In California, escalating wildfire activity has led insurers to non-renew policies en masse, forcing homeowners into high-cost, state-run insurance pools or leaving properties uninsured. The result has been reduced market liquidity, diminished property values, and increased economic uncertainty. In Florida, Hurricane risk has similarly prompted insurer withdrawal, with localized housing markets experiencing volatility and increased financial strain on both homeowners and municipalities. These examples demonstrate that climate-driven financial disruptions are not hypothetical scenarios. They are ongoing, observable phenomena with immediate economic consequences. By grounding the discussion in real-world cases, the senator underscores the urgency of proactive Treasury engagement and the necessity of systemic risk modeling. Segment 4 also delves into international comparisons and best practices. Nations such as the United Kingdom, Australia, and Japan have implemented measures to maintain insurance market stability in the face of climate-related disasters. These include government-backed reinsurance schemes, climate-adjusted risk pricing models, and public-private partnerships that incentivize resilient infrastructure investment. By analyzing these approaches, the U.S. Treasury can identify strategies to mitigate domestic risk while leveraging international expertise. Such comparative analysis underscores the importance of adaptive governance and highlights the need for Treasury leadership that is both informed by global trends and capable of applying context-specific solutions. Another crucial component of this segment is the role of data integration, predictive modeling, and stress testing in policy formulation. County-level insurance reports, historical disaster data, and climate projections can be synthesized into predictive models that estimate potential cascading effects on mortgage markets, property values, and municipal finances. These models enable policymakers to simulate interventions, anticipate systemic consequences, and design targeted solutions that maximize efficacy while minimizing unintended outcomes. Senator Whitehouse's insistence on detailed data review reflects an understanding that rigorous, evidence-based modeling is essential to inform decision-making at the Treasury level. Such approaches also facilitate transparency, allowing both markets and the public to understand the rationale behind policy decisions and to build confidence in government-led mitigation strategies.